Thank you very much, Mark. Now I will introduce Mr. Robert Weaver. And for those of you who are new to Property Partner, he's probably a face you'll start seeing quite often. Him and his team prepare the investment case for every property. They go to every property. You can click through and see a video of his view of every property. Robert Weaver joined us as previously being Director of Global Residential Investments at RBS. And on top of that, he's run £500 million residential portfolio before at Invista Real Estate, and set up the Savills auction team amongst many other things in his career. So it's a pleasure to have you in the team, Rob, but also please come to the stage and let us know what's been going on.
Is there a pointer? It's just on that. It's not a pointer, it's just a...
Everyone's been really struggling with this one.
I struggle with it as well. But can I point on the thing?
No, there's no pointing. Okay. You can point with your hand.
Okay. Good evening, everybody. Hopefully this will be the interesting part of the show. To start off with, I just wanted to share what I found on the ground post-Brexit, because I was, in London, the sentiment was crushing in central London and the city. Immediately after Brexit, the next day, commercial property funds were closing with regular monotony. And that's because there were massive draws on cash to come out of these open-ended funds, far greater than experienced at the global financial crisis, and that's a huge shock. Completely different for residential property. There wasn't that panic. It was complete opposite. There was an open-ended fund. We phoned them up and said, "How's it going, guys?" They had a week of net redemptions. And then following that week, they were back into net inflows of cash. So a very different proposition. But I suspect that's, again, sentiment-driven because, the investors in the commercial funds are based in London and the city, and a lot of investors in residential are UK-wide. And this was the interesting thing, because when I was getting on the road, I thought, great, really depressing times out there. And I say to Dan quite often, there's nothing like a weak market to be a cash buyer and have some fun. So I thought, great, we'll get out there. And so ready to do battle with the vendors and faced with a wall of happiness and brightness and say, what do you mean you're reducing the price? The price is going up. We voted for Brexit. This is great news. Business as usual. Far different picture out there. Now it's all settled down, and I think there's very much a big mood towards business as usual. Just want to cover off what our investment proposition actually is. You've heard from Mark, governing that we have the asset class is a high-performing and stable asset class. Sorry, Alan, you should have invested in residential, not Unilever. Okay, you might beat us by one. You might have beaten us by one stock. But the second thing was we have a really experienced property team. And the thing I would say about this, people actually have lived with buying investments, and that's very different. And I'll tell you a little story. I used to be an agent, and it was all, you do a deal, close a deal, high fives, strike the bell, do your invoice, and wait for Christmas, and you get the bonus, all happy times. When I became a fund manager, different world, very steady, lots of graphs, lots of research, missed the days of doing my deals, and then I was doing my first acquisition, which actually is a block of service apartment block of 10 flats just off Smithfield. And I thought, great, I'm going to get the excitement again, super. Had a real hard-weaving negotiation with the vendor and their agent, and eventually I got the call. You've got the deal. No euphoria. Now it was just, crikey, I've paid too much. And it's a different world because now it's not closure. I now start on a journey to live with that property, and I will be judged on that property until the end, until it's sold. So unless you've been through that, it's a very different buying experience, and you take greater care because you will live with it. Other things, we are assessing a wide variety of property types across the UK and all the regions, which are not normally available to individuals or buy-to-let investors by doing multiple properties. We look to deliver both a variety of income, growth, or a combination of these for the various properties. Diversification. We offer portfolio analysis on your own portfolio. There's liquidity there, as Mark said. 12 million is traded on the platform, and that's improving all the time. And then finally, it's ease of investment. You can do this all at a click of a button at your desk without actually having to go and get in the car and go and see the properties. So I'm going to cover off the selection criteria. Those who were here in December, I went through the bricks and mortar piece in quite detail. This is what I call the building types, age, its construction, maintenance, energy performance, safety, and so on. But once we've actually selected the property and it's passed all those tests, we then go through another series of data checks before we are even allowed to go to our investment committee. And this is, we look at the past performance of the area, its forecast capital growth, what its potential income yield is, and we model the net dividend, make sure it passed the minimum threshold. We look at the local and regional economy, wage growth. We look out for any whether regeneration or infrastructure projects. These are also a very good indicator of longer term growth. And also, what's the diversification appeal? Will this fit with the other properties on the platform we've already put up there? And so, once we've got all those and we're fairly happy with it, then it's at that point we go to the investment committee and then look for approval. That's not the end of it, because then we also want to look at where this fits in our supply pipeline. And traditionally, since Brexit, according to we've been looking to investor demand, investment sentiment, and there's been a particular push for yield, as Alan has been hinting at. So really, the majority of our offerings since Brexit have been on the higher yield category. Again, we're hearing that there's more demand now for any capital growth products, and offering a more balanced range. So we are going to start delivering these into the platform, and we actually want to just try and put these in the right order as well. It's not hard enough just buying the properties at the right yield and the right locations. We now want to try and deliver them in the right order, so we actually will have a capital growth and not all properties back to back. So we are looking at specific locations. There's a list of some here. Picking on a few, really keen to get something in Bristol, Slough and Maidenhead. I'm a big fan of the West Crossrail area. We're going to have a hard look at Cambridge and Oxford and the university towns there. I suspect these are very supply constrained. We haven't been able to find anything just yet, and I suspect they're also going to be very low yielding. They've had a lot of capital growth. Also going forward, we're going to look to increase deal size over the year. And ultimately, we're going to look at adding complementary assets. One of the ones we are looking at are developer show homes. And to give you a feel of what these are, if you've got a large-scale developer who's got a 2-year build-out plan or 2-year build-out plan, he'll have show homes. And these are sitting there, a drag on capital. So what you can do, we can look to buy these, lease them back to the developer, so you've got a guaranteed income for 1 year, 2 years. Show homes, you'll appreciate, are usually the best plot on the site. They've got the biggest garden, they'll have the best view, developers. So that's what we want to try and get. And actually, when the last homes are sold, they will go in refresher property. So we've got the newest property on that site. So, and we'll have collected any capital growth that's gained whilst getting this certain income stream. So we're really looking into that, and we're hoping to be able to offer one fairly soon. Just to look back at our, an example of our growth proposition, we actually have one on the platform at the moment. And I wanted to take you through sort of the acquisition history of this, the deal history. What we have here, we've acquired 2. This is a new development of 9 houses on the Tooting Mitcham borders. Now, developers gone through a little bit of pain here, and let me explain what's going on. What I've put in on the chart here on the right, I've put the order of sales that he's been selling the houses at. The November listing price when he started marketing these, the January listing price, obviously he's gone through a little bit of pain, and then the book sales and the order, and then the interesting piece, the pounds rate per square foot that's being achieved. So back to the start. This was listed in November. Not a good time to start. Coming into Christmas, a slower market, not a good time to be offering a brand new scheme. 2 things about developers. They have generally an overinflated opinion of what their properties are worth, and they have an overinflated opinion of how quickly they can sell them. So had I come in at this stage, said, right, I see your prices, but I want a discount, you know what they would have said to me. So we waited, and then after Christmas, New Year, some serious repricing going on. Interesting, this is a really interesting thing. 2 properties have been let, number 2 and number 4. Why would a developer want to let a property they're selling? He's under pressure from the bank. Clear, loud and clear. So he needs to get some sales going on. So he managed to sell the first one. This is the smallest one. As you can see it on the right-hand side, it hasn't got the extra roof. That's a 3-bedroom house. First one sold at £536 a square foot, quite a good rate. The second purchase, we know, is a cash purchaser. He's wanting to get sales done quickly. No mortgage, cash in the bank quickly. So clear picture was he needs to pay the bank off quickly. He gets 2 more sales. Now these, at the far left-hand side, there are 2 4-bedroom houses. The point to note here, they're a smaller square footage. He gets these 2 away. One is let. The first one away is vacant at £512 a square foot. The second one at £525. He's actually proving that the values are going up because a tenanted one should command less value than a vacant one. It's a smaller market. We're now getting interested, and we come in at this stage. He has 2 properties. We have one let and one vacant. Now, another pitfall you could easily make is normally smaller properties command a higher rate per square foot. That is true when you're comparing a 1-bedroom flat to a 2-bedroom flat. Not true if you're comparing similar properties of the similar size, 4-bedroom houses, for example, or if you're comparing 2-bedroom flats with 2-bedroom flats. Because if your 2-bedroom flats were both double bedrooms, comparing it to one which had a 1 double bedroom and a single bedroom, that's a less of a product. Same here. These smaller 4-bedroom houses only had, on the top floor, only had single bedrooms. Ours are double, and they command a higher value. They're more valuable. So an easy mistake would be that the smaller ones should command a higher rate per square foot and therefore downvalue the ones. So that led us to conclude that actually we are quite comfortable with the £650,000 asking price and VP price for the property. And so that's when we got in and negotiated a fantastic price of £505 a square foot. Now, the reason for this is, and I think that is that this now, he's getting to the stage where he can pay off the bank. So he will take this and take these kind of offers. The next deal he's done, and has agreed it at £650,000, £532 a square foot, exactly where we thought the VP value would be. The final piece to this little jigsaw is that he's now got 2 properties to sell. This is his profit element. This is where he can make his gain. So it's extremely unlikely that he's going to offer these at anything less than £650,000, and if anything, he will look to increase the price. And also, he can take his time. Once the bank is paid off, he can take his time to maximise his profit. So, in all probability, these prices are going to go up. So, even if it gets £675,000 each, that's an extra £50,000 gain on R2, which he would have made for us. So there's no such thing as a certain deal out there. But in my mind, that's a well thought out one, and in my view, a solid transaction. And it's interesting, and it's worth noting all the little clues that you can pick up from this. So why is he rented to? What's the history of actually selling them, and why is he done at those prices? And clearly, if you can get a cash purchaser in to pay off your bank early on, that's a good thing. Finally, we're near the end, so we're on to the wine soon. I always like to finish off what we don't buy and why, and then also kind of a bit of fun. I have a pet subject about permitted developments. And I have another example of what people shouldn't be living in. So the next one, it's a lovely chapel conversion in Liverpool in a really good district. It's a nice conversion to a good standard. As you see, it's all clean and tidy. Rented out, you see the bicycles there, and really high yielding. Now this is where I've got to be slightly careful with Alan. We're very careful. We don't value properties off yield, and this is where the mistake could happen. It's a good yield, 9%, exactly where we would expect it to be. So on paper, it's all looking good, and we go and see it. On the ground, we actually discover another chapel conversion where the units are retailing at 55,000, and these were being offered at 85. So that's not a deal for us. We won't value it off income. We always value the capital value, and the income as a byproduct. Finally, I want to leave this one for this is a bit of fun. As you say, we're looking to add more value propositions. So Slough, high on the agenda, Crossrail, that's going to have a bit of value growth here. So we're very excited about going to see this one. Complete letdown. What we have is, you can see the flat there. You can see the cupboard doors are open just in front of obviously the dining room, the four-person's table. Personally, I would make sure you keep those cupboards open all the time because that would afford you a bit of privacy because there's no, from the front door you walk straight into your dining room, kitchen. So you've got no privacy. So keep the cupboard doors open. That's always a good thing. After dinner, your 4-person's dinner, you actually now have to ask your guests to leave because that's only a 2-seater sofa. So actually, no, you can't actually have a sit down and watch the film together and have a two-cub. That's it, unless two people actually go to bed. The great thing, this is actually convenient living, because you can imagine, want a cup of coffee? Oh, just there it is. I didn't actually reach for the coffee machine, so that's convenient living. But the really shocking thing is, that flat that's the fourth floor one. I couldn't get the plan for the ground floor, but I went to see the ground floor one. It's on that corner, just behind the scaffolding. So that window, to the side of the sofa, that front window, those side windows, and I've kept the photograph deliberately close because you get a feel of where the next door building is. When I inspected it, I could actually see the guy working on his computer, and I could see he was working on an Excel spreadsheet. He was that close. But the really good thing is, if in the summer, June, midday, you might get a shred of direct sunlight into that flat, into those third bedrooms. But the next door room, you've got a nice sun canopy, so at least you won't fade the curtains. That flat will never see daylight in the two bedrooms. And I think that's a disgrace, personally. It's too small, no daylight. And that sort of thing we will never touch. So, but I can't imagine anybody wanting to live in a flat like that. And the people are making mistakes and buying them. Sadly, they have to live with the consequences because they're economically tied. But if I was trying to rent that, people would be leaving after 2 months, 3 months, saying, I can't live in that. And, I've been to flats, 700 square feet. That's about 300, 350 square feet. 700, double the size. Clothes spilling out of wardrobes, cupboards. There's only one cupboard, and that's in the kitchen. You can't live like that. So I'll leave you with that thought. That's me done. Over to questions.